All right, we back. Let's start off here with the 10-year yield. The reason this is important, mainly because Gregory Mannarino says it's super important, but no, it's really important because this is really what everybody looks at as kind of a gauge of economic health. And tracking this is probably the first thing you need to do, at least just so you get a sense of what the market's likely to do next. Whether there's a lot of fear in the market, that kind of thing. Now, I'll refer you to Greg Mannarino to explain more on why the 10-year is super important. He's way better at explaining it, but it's definitely something you want to watch. Right now, we're obviously looking at a clear downtrend. So something I use here is this stockcharts.com, and so you can find ratios and stuff like that, and you'll see them right here as I go through them. So we're looking at the 10-year yield. We're obviously, let's just make notes. No bias here. We're just going to look at it, look at everything, and then by the end of the video, hopefully you have a sense of what the market is trying to do or where it's at right now, and then what's likely to happen next. So that's the plan here. So we're just looking at the 10-year. Obviously, if we just look at this and we had no bias, nothing, then we're obviously bearish. Just on the 10 years, just obviously a small downtrend. Okay, 10-year and a downtrend means that economy not looking hot means people are buying bonds. I'm going to try to keep it super simple. People are buying bonds right now. So people are buying bonds. What are they doing? They're flight. It's kind of like a flight to safety type of situation here. People are buying large tech companies, kind of like they did back in coronavirus. So it seems like people are getting scared. I don't know if that's the context here of why this is happening. It's just my what I've seen so far. So the trend is continuing. It looks like it has some support here, maybe at 124, just because that's the 200-day of this thing. So I just kind of look at the RSI. I don't care about the RSI and MACD too much, but I'm just kind of looking at them, and they just look bearish. So this whole chart looks like crap. If you were going to try and buy the dip here on the 10-year, like say it was a stock or something, it's not. But say you were going to try and buy it, you would wait. You would want to wait till maybe here, right? Because that was your last breakout spot. So the 10-year, the trend looks like it's going to continue. The next inflection point is probably 1.24. So if this reverses, then that tells us something. But right now, as it stands, as of today, most recent data, this is where it's at. So let's just keep that in mind. Next, I like to look at the SPY versus the 10-year. Okay. Usually when you look at a SPY chart, it's going to be essentially denominated in dollars, but we want to look at it as a ratio to the 10-year. And so we're looking at this, and we're seeing that SPY is coming up to the 200-day on this ratios chart. Okay. And we see RSI getting a little bit up there. I look at RSI over 70 as more of a momentum type of thing, not as a reversal thing. So if you're looking at RSI 72 here, I'm thinking that it's got some pretty good momentum going on right now. And we got MACD looking pretty decent. Again, I'm not a big fan of these two indicators, but using stock charts free version here, I'm just going to use them just as a basic. I really don't need them because I can see that we're making higher highs and higher lows here. With the Bollinger Bands, we're outside of the 2 standard deviation, but we're coming up on that 200. So I'm keeping that in mind going forward. Is that going to act as a resistance? Are we going to see a drop happen on the SPY because we're running into this resistance here? I don't know. We're running into the 340 level, 335, 340. I'm sorry, 435, 440. Which is crazy to think that we're up here. It's not really that crazy because we're probably going much higher than that eventually. But as of right now, it looks really bullish. So as of right now, the 10-year is bearish, SPY is bullish. Okay, so let's move on. QQQ. Similar situation. So you can see the charts look very similar when compared to the 10-year. But, we got the same exact type of chart. Okay, and we're putting it up against the 10-year. Obviously, a lot of these indices are probably going to look very similar. But we're going to go to IWM, and it looks a little weaker just because we got this one about to touch. QQQ is about to touch that 200. SPY is a little bit further away, and then IWM is quite a bit further away. But all in all three indices, at least obviously compared to the 10-year, which is essentially diving, all three indices are moving up here into potential resistance. So we got three indices moving into a 200-day average versus the 10-year, and we got the 10-year coming down to its 200-day. So we got a little bit more movement. So I don't know, looking at these four charts here, we're right now we're still bullish until it tells us otherwise. Okay, because we could slice right through that. I don't know if this 200-day is going to be resistance. I mean, why is it not the 201 day? You know, why is it not the 209 day? You know, the 200-day is so arbitrary. So it's just there as a reference point. We're just going to keep it in our heads, keep it on the chart, use it as a reference, at least for now. Here's the VIX. The VIX sitting here last 2 days, okay? The way to look at this is that last 2 days we tried to rally, okay? We tried to rally above this line here, but this line right here is last week's high, okay? So last week's high, the VIX, this is VXX, which is the ETF essentially, but that tries to rally above last week's high, can't quite do it, gets shot down again, okay? Then the same thing the next day. We have a gap down, tries to rally again, and then gets shot down. Now this is going to play into something I'm going to say later, and I'm going to get into some things which are way over my head, but I have a slight grasp on, and it definitely helps me mentally when I'm trading. So keep this chart in mind as well. We've got basically a double top forming. Doesn't mean it is a double top, because at any point in time, if this, I mean, you know, you're seeing these lows here are getting a little bit higher, a little bit more contracted. So when I'm looking at this, I'm saying two scenarios is we either break this white line, which is a monthly level, we break that, and then break this weekly level here, this yellow thick line, and head for the last week's lows on the weekly, or we're gonna bust right through these last week's high, and then that's where we're gonna see that volatility expansion, at least in the short term. It's gonna play into something I'm gonna say later. Okay. Next chart, here's the VIX. Here's the VIX from stock charts, which are, you know, your basic indicators. I mean, it just looks super bearish on a daily. So at any point in time, obviously this can rip, but you see kind of like where it rips. It usually rips when this Bollinger Band kind of contracts a lot, and then it goes higher. But overall, I mean, it's going to take a huge monster event, bigger than coronavirus at this point, to really crash this market like it did last year. And I think most of you probably know this, but that's just kind of what you're just getting a sense here, that, you know, to break a 50-day and all the other moving averages that are in here, and then to get to the 200-day, you know, it's going to take quite a bit. The MACD is way under the zero line. You got the RSI under the 50, just going sideways. Nothing's happening. Again, this is going to play into something I'm going to say later, so keep that in mind. Here is one of my favorite indicators, which is just the advanced decline ratio. As far as this looks, it's, you know, again, I'm just using the 50 and 200 as a reference. You can use a 20 and a 30 if you wanted, or you can use a 5 and a 10. I'm using the 50 and 200 because I'm lazy, and I'm just keeping it on the chart because it comes defaulted on there. But it does give you a good reference. So again, we're looking at this, the advanced decline ratio, stock issues in the NASDAQ that are advancing, divided by the ones that are declining. So if we see this happening right here, it just means when it's low like this, means that there's more declining, right? So we're not having too many advancing issues versus declining. So there's an imbalance to the downside, and so that doesn't really bode well. I mean, I'm just looking at it. You got the 50-day underneath the 200-day, so we had this cross here, and so I mean, I'm just keeping an eye on it. It is a higher low, at least for now, versus this June 22nd. So again, it doesn't look great, but it hasn't looked great for a long time. It's just they tried to break it out here with a higher high from here, and then that failed. So keeping that in our context here of there is a chance for a volatility expansion event happening soon, but it hasn't happened yet. So we're just monitoring the situation. As of right now, everything is all systems go for higher. Next, the McClellan oscillator. I'm not an expert on this, but I have been exposed to trading with it. When I was in the Smarter Trader chat room, the guy used this McClellan, and it worked like a charm. He would call big expansion days, big trend days all the time. And he even called the exact day of the bottom last year. Follow Steve D on Twitter. He doesn't really have a lot of followers, I don't think, but he's a great trader, and he turned me on to this McClellan. So we're looking at the NASDAQ version of this, and right now it looks like it's, you got this 50-day rolling over, okay, but it's not under the 200. These other indicators don't look all that great, but you see what happens every time this gets down to these lows. It almost looks like the exact opposite of this one, in my mind. Exact opposite. I mean, it looks like a carbon copy. I don't know why I said exact opposite, but see, it's making new lows here, but when it does this, it looks like it likes to rip back up. So I'm keeping an eye on this. If it keeps going lower, I don't know if it's gonna be like a rubber band effect, like if you get an oversold RSI or something where it just pops back up. But this going down while the NASDAQ is going up, we got the advanced decline ratio going down as NASDAQ is going up. Those are divergences that we want to keep an eye on. So it's kind of looking a little bit like people are maybe running for the exits here a little. So we're trying to take a look into we're trying to pull the proverbial skirt up here on the market. I don't know why I use that reference, but it's kind of what you're doing. You're trying to look inside. Here's another one. This is the NASDAQ one. Let's go back over here to the Dow. Here's the Dow. So we're looking at the NASDAQ advanced decline. Now we're looking at the Dow. And the Dow looks a little bit different, right? So here's NASDAQ. Doesn't look great. The Dow bounced. It bounced off these 5200s, and it made a new high relative to the last one. So very interesting setup. I was looking at this yesterday where it closed here, and I think the Dow had a pretty decent day today, if not held us up. So the divergence happened yesterday, I think, where the Dow was way down, but we closed right in the middle here on this breadth, which is just a breadth indicator. And so I was thinking when I looked at it last night, I was going, wow, that's kind of interesting. So there was a divergence where you're way down on the Dow, but it closed flat on the breadth. There was a good chance that you would see a rebound there, and I think that's why you saw some of the high flyers from yesterday were kind of muted today. I mean, Apple had a good day, but Amazon, Shop, a lot of choppiness. You were getting whipsawed left and right if you were trying to catch breakouts. You could play the middle, but if you're trying to catch breakouts, you're getting destroyed. Some of you probably did. I got tempted to, and I was just like, I'm not messing around on day twos. You get destroyed. Day ones are the best for breakouts in most cases. Day ones and maybe day twos. Day threes, you get, I don't know. It's getting really nerve-wracking then. But next is the breadth momentum. I like this one for just the NYSE common stock. It looks oversold. I mean, if you're going to talk traditional chart reading, you've got some real, you could say the momentum is really low and that it's super bearish. So as of right now, it's just making new lows. It even undercut this low on the breadth. So another divergence here. We got SPY and stocks kind of ripping higher, and we're getting these breadth indicators, at least for NASDAQ and NYSE here. And you're going to see SPX here in a second. You're seeing these going down. So let that tell you whatever it's going to tell you. Here's the McClellan. Doesn't look as bad. It made a new low relative to the last one, but didn't close as bad as it did on the 21st. And we saw with the 22nd here. Yeah. So the 22nd, 21st area, that was kind of where the last dip happened. So we're not seeing as bad of a dip on the indicator, but we're seeing new highs every day. But we're not seeing these breadth indicators go with it. That's what we would want to see. We'd want to see these start going with it. Here's the McClellan. Now this one looks a little bit better just looking at it. Obviously, it looks like it's trending up. So that's a good sign, but it's not all that great. We've got way more divergence happening than we have confirmation of a trend. So we do have the 50-day underneath it. So I don't know. I don't know if that's a thing, but it looks like it's a thing. If they can, obviously we follow price. So if they're going to keep ripping this higher with the SPX, I'm good with that. Okay, so just a quick overview of all of that. You guys take that information as you want it. To me, the way I read it is that we're getting close to a point of a turn. I think it happens next week, and the only reason I think it happens next week is because this guy here, he's an incredible volatility expert, and so he's going to be using like options flow on the SPX. He's going to be using institutional flows. He's going to be looking at VIX flows, that kind of stuff, and he's going to be kind of coming up with these windows and these opportunity time frames where things are going to be. So he'll give you a sense of what the weather is like with the market. So lately it's been, the market's been kind of in a pin mode where SPY is just melting up, right? You've been in part of those melt ups before where it just seems like it just grinds higher forever. Okay, we're never going to see a sell again kind of market. And then all of a sudden, boom, one day something happens. It's always something. And the market it breaks the trend, and then we start seeing that choppiness again. Well, he's calling for this. You can see it. And if you've been following this guy, he's been calling this the summer of George. And you have to understand why he calls it George, is because he uses some of the volatility Greeks. He names them. Like one of them's a monkey called George. He loves bananas. Basically, that's a metaphor for the Fed basically pumping these volatility flows, which basically cause market makers to have to be, I think it's long calls, short puts type of situation. So as long as they're long calls, short put, the market's just going to keep grinding higher. There's an oversupply of volatility, which means that every time the VIX spikes even a little bit, this is my understanding of it. Every time the VIX spikes even a little bit, you're going to see the holders of volatility getting out, selling it. Kind of like you would see in a pump and dump type of situation. You ever been a part of a pump and dump in a stock where it rips and then you just see it just dive? Well, that's because whoever was in it before the rip, they're all selling the top. There's just too much supply of shares on the market to overcome the buyers, and that's what's happening with the VIX right now. But he's calling for this to happen on Monday, where that volatility supply, it's still going to be there, but it's not going to be as bad. It's kind of unpin the market. The market's been pinned. He's saying that's going to kind of come unhinged soon. You're going to see volatility has already started to crease into the rally. This is what we're seeing. We're seeing volatility increase into the rally. It's failed twice. So what I'm watching on the VIX is a breakout of the last 2 days. We want to see a nice, strong move to signal more downside. It'd just be volatility, like a correction. We would need a correction. It'd be really nice. Again, I don't care if it keeps ripping higher, but it'd be really nice to have a correction, kind of reset everything. It's hard to buy. It's hard to buy Roku after 10 days straight up, or hard to buy Apple after like 10 days straight up. It'd be nice to get a dip for everybody. But look what he's saying here. The price action front ran this week, and now that we're here, the call squeeze is likely to continue. The call squeeze. If you guys have ever been a part of a gamma squeeze or a squeeze, it just means that the market makers are having to hedge their short call positions in order to neutralize their delta. And I'm not going to get into all that, but you just have to kind of follow this guy and figure out what he's saying, listen to some of his podcasts, his YouTube videos. But let's just keep reading. So through at least next Monday, as this week's strong charm dynamics, charm is one of the volatility Greeks, should help accelerate buying into the mornings and end of days. This is kind of what we've been seeing for the most part, mornings, end of days. Let's just look at SPY. We had a whole day there. We had a nice sell-off here, which was really helpful to kind of accelerate the move higher. But you're seeing kind of that pattern develop, and it usually is like that too. You can trade from 8:30 a.m. Central Time to like 10 or 11. That's when kind of all the moves are happening, and then you got to wait till like about 1:30 or 2 o'clock usually for more moves. But let's see here. So it's early, but I'm starting to hear prints in the background as with shades of 1998, 1999, when hedged longer dated calls were a no-brainer for almost 2 years as the market volatility increased with multiple 10 to 20% plus declines into vertically accelerating final rally. Closely as longer date call vol should continue to outperform longer date call vol. So he's saying that this is my understanding. Now some of you guys might understand this way better than me. My understanding is that he is trying to outperform the market by buying longer dated calls, and I think he's more out of the money too, because he's always talking about his tail risk. He's always longer dated calls, further out of the money. So he's protecting his tail risk. Say the tail risk is 5-10% of something, some kind of event happening or some kind of super volatility spike. So he's buying those, and he's shorting the local vol. Local vol meaning he's shorting like Friday's expiration vol, and it means he's selling calls to people. So he's probably selling calls here, probably selling calls here, knowing that the volatility is oversupplied. So hopefully this isn't going over people's heads here, but this is just kind of what I'm looking at, how my mind thinks about the markets, just kind of using the information we have. Another thing too is, as discussed, this could serve to unpin. This is what I was saying, unpin this market as we get into next week. So next week, 7/12, he's thinking that this is going to be the window when this volatility suppression, because of the oversupply, that kind of becomes unhinged, unpinned. For an intraday reversal off highs after a morning rally, but keep 1 foot by the exit essentially. So he's saying, so now we're seeing kind of like this all come together with what we're looking at: breadth momentum, we're looking at volatility, we're looking at a situation where it seems like people are already kind of going for the exits. Doesn't mean it happens tomorrow, but it just means like we should start thinking that way too. I think that's what I've been doing. Everything from last time still applies. So he's been calling the market since I've been following him, literally like almost to the day. And so I would definitely keep him on your Twitter feed. Keep him at the top of whoever you listen to, your gurus or whatever. He's not a guru. This dude is an actual guru. So I would definitely keep him on your list of things to follow. So hopefully this helps you guys get a little bit deeper understanding of the market. I'm not even close to anything like this, but if this helps you guys, if you're a newer trader or something like that, start rounding out your game here. Start getting a context of what the market's trying to do. Start getting a time frame, so that way you can start planning ahead and preparing for these type of events. And it helps you too if you're in a position to know what type of environment you're in. If you're a theta type of trader where you just like to do spreads and sell calls, sell puts, it helps to know that the market is in a kind of a pin or melt up type of grinding market. That way you know what strategies to use. So anyways, hopefully this helps you guys. Let me know if you like this kind of video. I'd be willing to do this type of thing every day if you guys do like it. If you don't, I ain't gonna waste my time. So leave a like and share the video. Thanks.